So good morning to everyone. I'm going to be talking about a model that I have a lot of confidence in that I trade pretty much every week. And I'll give you a little bit of background into how I use it, maybe a little bit of background into my journey, why it fits with my personality as a trader, and then the tools that I use. Specifically, I tend to use the weekly volatility grid indicator because when I'm referring to a one shot, one kill model, it means a broader movement in the market. So I'm trying to capture a lot of points when it comes to trading the NASDAQ or anything else, right? So that's what I'm trying to encapsulate. For me, it's a reversal framework. So I'm looking for reversals off these key areas, and I'll talk about what they are. And it's built off the root candles, AMRP from the tool, as well as SIF entries, which I will break down as well. For those that don't know what SIF is and how I use it, just refer to the YouTube channel. It's all on there. So for me, it's just a more refined approach that I tend to use, right? And I'm looking for a rotation and a reversal from a trending market because most market moves are not trending, right? They're rotational. So I'm looking for that cycle to take place, that accumulation, expansion, distribution, and reverting back to those key opening levels. And that's essentially all I do on the week to week basis. So without further ado, I do want to disclose this, right? No, this is advice. So I do want to point that out. It's just the way I trade. Now, the tool framework, I'm going to use the weekly indicator, and that's what I use on a weekly basis. If I'm not scalping during a live session in front of the community and I'm not doing a live trade or anything, or I don't have enough time on the day because I'm doing other things, then you'll probably see me trade when I'm about to show you. It's the one shot, one kill. I'm looking for a broader movement in the market, really large range to take place, and a reversal to take place from these key areas. With the actual framework that I'm using, the tool, it's going to be the weekly volatility grid indicator. This can happen across crypto, forex, futures. The same framework applies, and we're actually going to look at several examples of that. So, what is the framework? It's AMRP, which is giving me a stronger edge. Really happy with the outcome of that. Again, props to the Toodegrees team for that. Originally, back in the day, I was simply using the root candles. So I'll show you how to do that as well, because those roots for me were distinguishing discount or premium opportunities from the opening prices within that volatility time slot. That's what a model is for DTT. So back in the day, I used to just use the roots, and that's fine, right? But now, Toodegrees, they gave me AMRP, which is a stronger edge that I use along with the framework, because this gives me those precise areas that I'm looking for with a statistical advantage. And I'm basically fading these volatility spikes. Like when price really moves aggressively towards one direction, I'm basically fading that once my entry criteria takes place. So now the question might be, what is that entry criteria? And that's the SIF entry model. It's built off inversions, and I'm using the bodies on the right side to look for a trade. Once price inverts a fair value gap, I'm not looking at the fair value gap, but I'm using the body here. So we'll talk about that. I'll show you some examples, but this just helps me understand price a little bit more when I'm looking for a either swing trade or perhaps again just a really strong movement to take place during New York session. And one actually happened today, so that's actually going to be really cool to talk about. It's a mechanical method, right, that I'm using for a price entry. And again, it's just taking place with the root candles and AMRP, but I'm using the discount or premium bodies after the inversion takes place on the right side of the curve. I know it's unusual, but that's just the way I do it. And for me, it works. So I think the results speak for themselves. But let's go through some examples now. And so, as far as the framework, before I start talking about the indicator, which is really beautiful because I'll show you how I use it, I want to talk about really quick just SIF framework. So, we all know what a fair value gap is. For those that missed the lectures previously or YouTube videos, once price closes through it, and for example, it closed through on this candle, then I'm not referring to the inversion there, right? I tend to look at the body that went into a premium there. So real quick, see that premium price above 50%. So this is the body that I'm going to focus on. if I were to look for a trade or an entry. So we'll just drag that over. The reason I like looking at the body and not the um, inversion itself is on my end is because when I'm looking at the body, if it stabs into the 50% mark, that's fine, as long as it doesn't close above it. If it closes above, then for me, that's a warning sign that, okay, this thing is probably not going to work out. I can cut the trade early or perhaps mitigate risk, right? But if I see it respect it, wick into it, then that's a really good sign and I'll hold on to the trade. Another reason is because I do like the precision there. So we'll look at another example. You see how price inverted this fair value gap on the hourly. And this is actually the example I will talk about that happened today. So instead of me looking at this broader area, I'm looking specifically at this upper body right here. And I want to see price stab into it and then reject off of it. So pretty basic framework, but that's what I use for price entries. And now, as far as the indicator, what I tend to do with the indicator, I have these alerts on. So I have it off here so you guys can see what it looks like. When I turn these on, I'm looking for price to hit AMRP. So I don't have it on here, but it'll be these upper ranges here, which we all know are statistical and discount ranges, as we can see. So I'm looking for price to stab into those occasionally. If I ever get an alert, then I'll quickly look at the chart, see if there's a SIF entry on the 15-minute chart or the hourly chart. Those are the time frames I use for this model, 15-minute and the hourly. So once I get an alert from the indicator, I then check like the next 15 minutes, the next hour. I keep checking to see if my model pops up for a price entry. Once it does so, then I'm into the trade pretty much at that point. So first, I want to talk about the root candles there because this is what I used to use back in the day. It'll be the same thing, but again, AMRP gives you that extra edge. So we all know what the power of three is, right? It's a pretty basic concept for those that don't know. I'm pretty much doing that, but it's based off volatility ranges and time-based ranges. Power of three, you have an opening price, you'll see a manipulation, and then you'll see the distribution thereafter. Price will revert back to the mean, manipulate, and then distribute. That's what I do, but again, it's based off these volatility models. So the root candles, that's what I'm looking for. That's what I'm referring to. I'm looking at this root candle here. I'm seeing that as price distributes down. I'm looking at this as a discount opportunity. However, I don't enter the trade unless an SIF pops up. Once it does, whether it's on the 15 or the hourly, then I'll show you guys how I hop in the trade. Sometimes price won't give me an entry, and that's completely fine. But there are a lot of opportunities where it does, and even more so, that's where I start to look for those opportunities. So, for example, in this price leg, we can see that price closed through several fair value gaps on the left side. So there's several opportunities. And I'll show you guys all of those so we can understand what's happening there. There's a lot that's taking place there. So once price closes above that bearish fair value gap, that would be your entry right there. When an SIF pops up, I now have 3 points of interest for an entry. I can either enter at the closing, 50% of the body. I'm not measuring the wicks, I'm using the body here. Or I can enter at the opening, which is all the way down here. So at that point, I have 3 choices to make. Where do I want to enter? If I enter at the closing, then I could put my stop at the 50% mark, or perhaps right around there at 75% of that body. And then I can just target the root candle here as a draw on liquidity, or perhaps the opposite side of AMRP, right? Pretty much that simple. Now, let's say I missed that opportunity, right? Didn't get in a trade there. Price ran without me. Then I'm looking at this inversion up here. Once price closes through this one on this candle, to make it more refined, I'm going to use the discounted body. So my eyes almost immediately go to this opportunity here. I want to see price stab into it, respect the 50% mark. I'll hop in a trade there, and I'll ride the wave all the way to the root candle and just let the position run. This happens with the root candles, as we can see, or with AMRP, which we will get to in a moment. Now that price is pushing all the way up, you can see how there might be another opportunity up here. I can jump to the hourly or the 15, and we are in a premium above the opening price here. Once that happens, you guys know the drill. I'm looking for an inversion there. And I will hop in a trade there. Now, this is all in the NASDAQ, but we're going to look at crypto. We're going to look at Forex, and it'll be the same. So you can see how it stabs into the premium. I'm pretty much just looking for this price entry to take place. Once I hop in, let's say I enter at the closing price there. I set my stop above the opening. And at times, if I want to give it a little more leg room, then I'll put it at 1.25 or 1.5. And I either go for a projection most of the time, or I go for a clear draw on liquidity. If I were to have taken this trade here, I could either go for this low resistance sell side, back to internal liquidity here, or I can simply just go for the projection if I'm not really looking at a specific target, right? And just trying to maximize the trade and letting it run. But again, this model pops up like at least once or twice a week. It's kind of cool. Best case scenario, it pops up like 3 or 4 times a week, and those are the best weeks. And that's actually one of those weeks this week when the market is kind of ranging. That's when this model pops up the most, and boy, is it fun. So let's actually look at AMRP now at this point, and I'll show you how you can refine your entries a little more. So we'll just turn this on. So now I have these statistical ranges. You can see how I can have pretty sharp entries and now a little more confidence. It gives me that extra confidence boost because, again, back in the day, I used to just use the root candles, right? And that's fine. But at the same time, now I have these ranges here based off statistics. So it gives me that extra confidence boost knowing, okay, this is definitely a key area to look at for that price entry. Something I like talking about with these ranges too is once you have a pretty decent trend, for example, price starts to distribute down, you'll often see it revert back into premium pricing, which is this area up here. When that happens, you'll see it snap back and continue the trend. I love those moments because this happens on intraday models too. So if you ever miss the trade in the first model, that's why this indicator helps me be really patient, because if I ever miss the model, then I just literally wait for the next model to pop up. It gives me some new ranges to work with. And then I look for the same thing. I just hop in a trade at that point. Basically, if I miss the first bus, I join in on the next bus, right? Now, I either look for it on the 15 or the hourly, as we can see. So I'm keeping an eye peeled for an entry on the hourly or the 15 at that point in time. You can see on the left side here, all of this is being balanced out. So there's no inefficiency and there's no trade that I can take place there, right? But as we talked about earlier, if I still want to refer back to what happened previously, which we use this as the first example, we can see how we close through that fair value gap right there. So this candle here, I will leave that as a point of interest on the chart. I don't like having too many drawings on my chart I like to keep it clean. So these areas here, that's all I'm looking at. If price is trading up in this PM session here on Monday, I might just look at that area or even on the 4-hour chart as a point of interest. When I mean a point of interest, I'm essentially looking for price to deviate away from that area because it's bearish, right? So then at that point, I might hop into a lower time frame, go on the intraday models, and maybe see if I can find a trade using the same framework there. If not, it's fine. Then I just wait for a different opportunity later in the week. But it's pretty much that simple. Now, the reason why I like to point this out is because through all this noise here, once price goes into a discount beneath the roots here, you can also change the look back, by the way. The look back means how far this indicator is looking back to measure these ranges here. So if I change it to 6, you'll probably see it come back up. You can see it pushed up a little bit there. Let's see if it's loading. Even more so if you change it to 3, you'll see the ranges change and alter. So you can see how price went to a discount there on a look back of 6. And to put in one sentence, I change it just when there's different volatility. Like if the market's really volatile, I kind of want to refer back to more days and give me better data points, right? If the market's kind of ranging, then I lower the look back. It's pretty much that simple. So if you have a look back of 6, you'll see it stab into a discount. Once it does so, start looking for this one shot, one kill model. Just look for that entry because all this to me is pretty much noise. And if I were to just draw two things, the only thing I'm looking at here, as we can see there, is going to be that inversion that takes place right in the middle. Because this is such a large move here, I'm going to watch two things. So we're going to draw that there. The framework goes that if it stabs into the discount there of the fair value gap, once it gets inverted, I will refer to that. But do you guys see how it's closing through 50% of that? So for me, if I were to see that and I'm trading intraday, I might wait for the hourly candle to close, which is 12 p.m. in this case. And if I see it close beneath it, the first thing I'm going to do is just think, okay, I'm probably not going to look for a trade there. But it's possible price could still hold this area because, we are in a discount. So there still might be an opportunity. But looking at this area, I might look at this body at that point and look for the same thing. As long as it doesn't close beneath 50%, I could still maybe look for a trade there. But this then tends to go into the 6 p.m. opening. So it's probably not a trade I would take there. But I do want to point out that's how you would look at that opportunity. Because there is a lot of noise here. You can see how there's a lot of back and forth price action, right? And then we had FOMC the next day. So for FOMC, the model just simply didn't take place. Like there's no opportunity there at that point in time on the hourly. If you were to look at the 15, once price stabs into a discount, it's beneath the root. We're going to use this body here. This is, again, a trade I probably wouldn't take because it stabs into the 50% mark and it closes beneath it. Even if it does push up, it's kind of pushing the buttons at that point because when I'm looking at this area, I don't want to see it close beneath 50%. But it's still pretty cool to see how it respected the opening price and then pushed all the way back up with FOMC day. So that's pretty cool to see. But I do want to point out, whenever you see this is probably not something I would take. When it stabs into the 50% mark, closes beneath, I'll probably just leave it alone. Sometimes you can even do quick scalps with the root candles as well, but that's not something I'm going to talk about there because I want to focus just on this here. You guys can probably see it there, right? It pushes into it, and then you look for an SIF right there. So this pops up again once or twice a week. You have many opportunities. If you miss the first train, just wait for the next one. But you can see how we're now in a premium. I'm looking over here. Is there an inversion? Nope. Price is respecting everything here. Everything's being balanced up here. Price continues higher. And I want to point this out. This is not the one shot, one kill model, because if we're in a premium, if I zoom out, we're in a premium, right? You notice there's an opportunity with an inversion fair value gap there. It works. It's doing its job. See a price respecting 50% and continuing higher. But that's not the one shot, one kill model, because I'm essentially looking for a reversal. This could work out. However, what I'm looking for is a move back to the mean, which are the opening prices. So once price is all the way up here, then we'll keep our eyes peeled. Look for the same thing. There's the inversion. I use the body. You get in at the closing or 50% or opening if you think it's not as strong of a move or reversal. But in this case, it stabs into the closing price and then continues lower, taking out all this liquidity over here. So a lot of opportunities there, and it'll repeat over and over and over again, whether you're on the hourly or the 15. Those are the only time frames I use for the one shot, one kill model here. But once price closes through this fair value gap, for example, or even this one, eventually, I don't think it's close through it just yet, then you repeat the process. So for example, it closed through this one. We're literally just going to go, if you want to do it quickly too, like you don't want to eyeball it or anything, what I like to do is I go to the first area where the fair value gap got created, and I just draw a line and I move it across. The first body that stabs into it, that's bearish in this case, that's the one I'm going to use. So we just put that over there, and you'll see how this morning price respected that and then pushed all the way back down, taking out this low resistance liquidity. Same thing on the hourly. I think we looked at that, right? It's the first candle body that stabbed into there. So you'll just draw the whole body there, use it as your point of interest. And I think it's still working its way. So we did tap -2 projection already, but that's the point of this model. We're just looking for this to repeat every single week. So yeah, so if you practice this and you go and backtest this with the indicator on the charts, you'll start seeing this like, it's going to be so funny because you'll start seeing it like nonstop and you can't unsee it once you see it. That's why I love it so much. But all right, so for example, let's backtrack a little bit. We're actually going to do it as if the model is taking place. So Euro USD, it opens up. You can even add a little more confluence to give yourself that confidence boost. Maybe you understand the higher time frame really well as a trader, and perhaps you're looking at this and assuming, okay, we're in a clear uptrend on the higher time frame. I might be more inclined to look for bullish opportunities with this one shot, one kill model. So when you do that, you're kind of filtering out the bearish trades. I kind of still go for both because at the end of the day, both opportunities do play out pretty decently and really well when I trade the NASDAQ, right? But on Euro USD, you might be more inclined to look for bullish opportunities. So let's see what happens here. I am on the hourly. We'll just use that time frame. So already, you might get an alert on the indicator. Hey, price stabbed into AMRP. Keep your eyes peeled. Then when you go to the chart, using this model, the first thing I'm going to look at is there a fair value gap? There's one here on the hourly, so I might keep my eyes peeled on that. And then let's see what happens here. So it continues lower. Okay, it's distributing. Funny enough, it's doing so at a key time, which is one of the intervals here. So maybe by 1 a.m. you'll see it push back up, right? Let's see it populate there on the chart. We'll make it darker. There it is. So one of those key times. Same thing over here. You'll see how it pushes up and reverts back at that key time. 9:45 Monday, boom, reverts back. Okay, so now that this happened, I'm looking for another fair value gap, whether it's on the 15 or the hourly. So there it is. It's on the hourly. What I want to see price do, I want to see it close above it. Simple, but that's all I'm looking for. Once it does so, you can see how it did on this candle with Euro USD. We'll just repeat the process. The discounted body, that's going to be my area where I frame a trade. Again, I have 3 areas to form a trade now. The closing price, 50%, or the opening. Now, I do want to point this out. This is dependent on you. This is the discretionary part because you're choosing where to enter. Do I enter at the closing, 50, or opening? What I do on my end is if I'm determining this to be a strong reversal and I think, okay, the market's pretty bullish here, I'm thinking I might get in at the closing. If I think, okay, I still want to do this trade, but it might not be as strong of a movement, then I'll see if I can enter at 50%. Sometimes I'll miss a trade by doing that. That's fine because this thing pops up like every week. But it's dependent on what you're thinking. If you're thinking it's going to be a strong reversal, you can enter at the closing. But let's see what happens here. So let's actually move this aside and we'll see how the next candle pushes into it or what happens, right? So you can see how you just stay patient, you wait for it, gives you that entry, and then continues higher. So next model, we'll repeat the process. Now we'll look for a bearish opportunity because it's in a premium. And we can see how, I actually want to backtrack a little bit there. Something I pointed out earlier, but I do want to point it out again. Because price is in a premium, we are filtering out the bullish opportunities up here. You can still do it. I'm not saying you can't, but this is something I filter out because depending on what I think price is doing throughout the week for the NASDAQ specifically. Because when price is in a premium above the roots, above AMRP or within AMRP, this will be your SIF, but at the same time, I'm more inclined to maybe look for a reversal back down. So as we can see, price closes through this fair value gap there. So we're going to use a discounted body at this point in time. This one's pretty small, so I could use that. But if I want a bigger range, I could just use this one, which is in the same area. We'll draw both, and we'll see how price interacted with both, just to see what happened there. So now for the next model, I want to see some speed, and then we'll see if it can drop down. So if I zoom in, you'll see how it stabbed into it. Again, I'm not observing anything else. It's just literally that body stabs into it, and then it goes to a discount here. And then we'll repeat the process. So that's Euro USD. Now, it's not going to work 100% of the time. That's every trading strategy. And I do want to point this little example there. Look at that. But you do rinse and repeat. And the more you do it, the stronger the reps become and you become more confident with it. It's only when you start doing something else that you start losing the confidence because that's where you start changing things too much. So, for example, this one here closed above. It did stab into a discount. So we technically would have to use this one. But what did I talk about earlier? If price starts to close at 50% and you still haven't been stopped out of your trade, maybe you have your stop loss over here or something, you might want to consider, this is what I do, right? This is just me. Let's say if I were to enter at the closing there and I had my stop down there or something, going for the highs, and I start to see it come all the way back down. I'm like, okay, it's coming down. Let's see how it closes. Let's see what happens. Boom, it closed at 50%. At that point, I might have to just take the L and say, okay, this is probably not going to pan out as I want it to, and I can mitigate the risk. I do have my stop here, and I have it set here, but I already see it closing at 50%, which is not a good sign. Maybe I could just cut some of that risk out, mitigate it, and then wait for another opportunity later on. And that's what I tend to do sometimes. I just cut the trades out, the losers quick, and try to hold on to the winners longer. And that's what this model presents, right? Another thing that, it's another golden nugget here. This is probably not one I would take regardless because the candle that made the low before the inversion is a bearish one on the hourly. For me, I'd rather see a strong up close candle there. So the fact that it's a down close candle, it could hold, but it's usually not that strong when that happens. All right, next let's look at Bitcoin. So for the crypto traders or Ethereum, let's see what's going on there, right? I'll go to Coinbase. Strong uptrend here. Let's go to the beginning of the week. All right, so Bitcoin, I could look at it on the 15 or the hourly. Let's stick to the 15 here just to see if there's more opportunities. What I'm already noticing is that most of this is being balanced out. So let's wait on Bitcoin here, see if there's an opportunity. All right, so there's a little bit of price action there that's taking place. So with Bitcoin, again, you're waiting for those roots to take place here. You see all the purple boxes? Those are the roots. Once it goes into a discount, that's where you start looking for the trade. Again, that's what I used to do back in the day, but now we have AMRP for that extra confidence boost, right? So when both are inside of this area, we're just looking for that SIF yet again to take place. Now, the way you would manage the trades here, you can see how it stabs into it after that inversion. Let me actually zoom in. Sometimes price is really detailed like that, but you'll see that if you zoom in, that's just the framework that I'm talking about here. Do you guys see that? The body smacked into it, that inefficiency, right? We all see that. So that's technically the one you would use. So if you're looking for a quick trade, if you're trading Bitcoin there, repeat the process. You don't want to see it close beneath 50%. See if you can hop in a trade there. Try to target the roots if you're looking for a quick trade. Maybe you can target the buy side, or again, just use the projections. You can put your stop at this area here and take profit up there. Then we'll see what happened over here. Let's dissect price a little bit. So over here, everything's being balanced out. It's kind of nasty looking. We'll see if there's an inversion that takes place. Now you can see how price did invert this area up here. But for me, it's a little more risky, right? It's not really the model because we're not at a discount. It's technically an SIF entry at that point based off the root candle support. So if I were to draw it here, that's basically where you're trading if you're going long here, but it's not the one shot one kill model because it's not all the way beneath the root candles or it's not at discount of AMRP. But regardless, let's see if it plays out here. So in this regard, you'll see that price pushed up a little bit on Bitcoin. Let's draw the projections there. And this is actually why I want to point it out, because that's not the one shot, one kill model. You could still look for a trade. You can take profits at these levels, maybe, or you're just looking at some liquidity pool, perhaps these highs, right? But once, again, price closes at 50%, that's where I would consider cutting the trade. So, for example, you see how I did it on this candle? Depending where you are, where you entered, I might consider cutting the trade at that point. Instead, what I'm looking for this opportunity to take place in the discount area. So beneath the roots or at MRP down here. Here we have another example of price pushing all the way to a premium on Bitcoin. And the process repeats over and over. See how it's at 50%, pushed all the way down. There's your trade. You're done for the day, done for the week. All right, so that's pretty much what I want to talk about. We talked about the framework, the basics. We went through part of my journey, a little bit of a snippet into my life. And then we showed many examples there. So now I'd like to do a quick Q&A. Are there any questions here that need clarification? Well, I can't believe it's already been like 40 minutes. That's crazy. The time flies, huh? Do I need a liquidity sweep first? No, I'm just going based off data point ranges and SIF. For me, less is more. That's the way I trade. Simple, but that's a good question, Cal. What caused me to come up with the framework for SIF for MBZ? To be honest, I would trade it for a long time, but I just didn't want to spill the beans. But now I do, because I think it's going to benefit a lot of people. But the reason I started doing that is because earlier on, when I was learning ICT many years back, I was trading those fair value gaps. I was trading those inversions, but I would get stopped out. Price would wick through it, and I'd be left wondering. And then they would go my way, and I'd be left wondering, well, what the heck? Why had it happen? So with MBZ, for example, I think we talked about in the last live, if I'm not mistaken. I'm pretty much looking at the fair value gap. So for those that don't know, I'm pretty much looking at the fair value gap, but I'm waiting for a confirmation. So for example, yesterday, right? You guys can see how price is cutting through that move down, right? There's a fair value gap on the left side of the curve. All these candles here, I would not take the trade because that's not MBZ. Back in the day, maybe I would. Maybe I would look at this fair value gap and assume, we have relative equal highs up here. That might be a good area. But nowadays, I'm looking at MBZ. So I'm looking at this fair value gap. Why? Because price closed through this upper one. So I'm no longer looking at that. But I am looking at these relative equal highs. When price does stab into that fair value gap, I'm waiting for a confirmation. And that's what this candle is right here. It's a bearish candle here, the body. I'm looking at the bullish one. As long as it closes above 50%, that's my MBZ. So the reason I trade like this is because, again, back in the day, price would just wick through it. And then that's pretty much it. I hope that answered your question, Cal. My favorite weekly intraday model? That's a good question too, Daniel. My favorite weekly would have to be Aries. They have names just for fun. Would it be Aries or Icarus? The reason I called him that, Aries tends to shed a lot of blood. You see how it's rampaging all the way down. Icarus, most of the time, when you have a bullish weekly profile, or the opposite, a bearish one, The reason I called it Icarus is because when it pushes too high up, what did it do? It flew too close to the sun and it comes back down. Otherwise, if it goes all the way down, Icarus rises and then pushes all the way to the sun. It's kind of funny, but that's what I was doing back in the day. That's why I like these. But the reason I like them, to answer your question, is because those are the models that have more volatility. And to prove it, let's actually go to the data table here. So that's where most of the volatility takes place. So you'll see it up here. Compare everything else, even on this week here. Icarus normally has a range of 1,300 points. That's the one we're in. Aries usually has a range of 685 points. These other models, there could be some decent trades, but these models are the ones I like the most. So I hope that answers your question there. So you have a question, Alex. I noticed you use deviations on the SIF for price targets. Is that your go-to method for TPE? For SIF, I like to call them projections because it's just a price projection off the candle. But usually, yeah, sometimes I just go for a quick TP on that, right? If there's a clear draw on liquidity, I'm trying to think of a trade that I took this week. But this week I was focusing on options more so. So let's see. Okay, so to answer your question, if there's a clear draw, like let's say these equal highs up here, then I'll probably just go for that. I try to maximize my trades. I try to cut losers quick, and then winners I try to hold on for dear life as far as it can go, because when you do that, you're maximizing your opportunities in the markets. So, for example, if I saw these equal highs and I got in down here, I'd probably hold on for dear life, seeing if I can maximize the trade. Otherwise, if there's no clear draw, right, Alex? If there's no clear draw, then you'll see me just take profits at the projections and calling it a day. Because for me, mental capital is also important. If I don't see a clear draw and price starts to consolidate, for example, up here, then I'll probably just cut the trade, take profits, and call it a day at that point. To set the MIPR alert, so you would go here. I see Josh putting some pictures in there. You can set alerts on ES, anything. So whatever you want to trade, cryptos, you can set alerts on AMRP. And I like having this on. I also like having the root candle on. If you're new to DTT, you can also turn on the new model start, but personally I don't need that because these times are pretty much ingrained in my head at this point. But you can turn on the root candle and AMRP as well. And this is the one I love the most with this model. So when this gets stabbed, I look at the markets, see what it's doing. If there's an opportunity, then there's an opportunity. All right, so we all know price here on Monday was kind of nasty looking, right? It was balanced in the books here and then finally started pushing up. But the way I would trade this and look at opportunities is, for me, once a clear trend is in place, and that's why I really love trend days or distribution days, because once a clear trend is taking place, every single model is going to give you an opportunity to ride the train. If you miss the first train stop, you just hop in on the next one, because once the trend is confirmed, I'm either looking for, again, an SIF or MBZ for an entry on my end. And what I'm looking for is, once price confirms the trend, you'll see it push to a premium, come back to a discount. And we'll actually talk a little bit about this area here. But once it confirms the trend, I'm looking for, as I showed you guys, discount opportunities beneath the roots, this gray box in this case, or perhaps even better, in a statistical discount. And as price continues, we keep repeating the process. I'm waiting for a discount, stabs into it, beneath the root here, boom. Might hop into a trade there, ride the wave until we reach a key time here, and perhaps price says otherwise. So when there's a clear trend, very simple, all I look for is to hop in on part of that ride. I'm waiting for an opportunity for price to go into a discount, I look for my price entry, and I ride the wave. This year is a reversal that took place, right? But you guys already know the drill. You would look for the same framework, an SIF up here. Because every daily profile is going to be different for New York, etc. And I can go through many case studies or examples, but if I were to put it in one sentence, the way I use the roots in MRP, again, when there's a trend environment, I look for opportunities to follow that trend until price tells me otherwise. Once it does tell me otherwise, then I'm expecting an expansion at that point, right? To the opposite side. And those are the days where price is trending. Those are the days where I don't have to necessarily wait. This is actually really important. When price is trending, I don't have to wait for AMRP. I don't. I hop in the middle of the range because I know there's a clear trend. When price is ranging and there's no clear direction, but perhaps I'm still looking for a tiny scalp, then I will look for, looks like we're too far back here to look at this. Maybe let's go to present day. Then I will look for AMRP to be tapped into. So drop a quick one if that makes sense. When there's a trend, I do not have to wait for AMRP. When price is ranging, I will wait for AMRP because it gives me that extra confidence boost. Because I'm expecting volatility to kick in at a specific time. For example, price is ranging here, New York open today. It's not going anywhere. There's no clear trend. I might wait for AMRP. And as I talked to you guys earlier, because volatility is low, I'll just drop the look back, give it a look back of 6 or 3, and then give myself tighter ranges to work with. And when I do that, I try to get in at a precise area for an entry with AMRP when price is ranging. But when it's trending and there's a clear trend, what you'll then see, besides the roots here, you'll see it snap back. So let's see if I can find an example here. I think Trump talked here or something. This is actually more of a better example over here because I think London or Asia was just consolidating. This is actually a perfect example. When price is consolidating, I want to get in at the statistical ranges. Consolidation, I wait for premium, I wait for discount at AMRP. Same thing on this model until it starts to expand. And let's see if I can find a clear trend here. Perhaps we can go back to this day before the reversal. Once a clear reversal takes place, and we looked at the weekly model, right? We all know there was a SIF up here. But if you're trading intraday, once a clear trend is taking place here, we are obviously pushing down. I will look at the roots. We will go into premium. But remember what I said. I don't have to wait for AMRP up here. I just hop in. If my model presents itself, by the way, I'm not just hopping in short up here, but if there's an SIF, you could probably see right there. There's an SIF right there on the 1 minute. Then I will just hop into the trade right there and ride the wave. This is actually a better opportunity because price is trending. And this is what I mean by a snapback move. You see how it starts to overextend a little bit? Price gets tired. They need to balance certain areas. I mean, price needs to balance certain areas, right? Inefficiencies in the market. And when price is pushing all the way down consistently, you'll see that quick snapback move. Goes into a discount, and this would be a perfect opportunity for a short. So I hope that answered the question there. But I try to make it as simple as possible there.